Hello, and welcome to the Stockout, the show at FreightWaves about CPG companies and their supply chain. CPG companies, those are consumer packaged goods. I'm your host, Mike Baudendistel at FreightWaves. Today, I'm going to be talking about the biggest story in CPG during the past week, which I think was pretty clearly Oatly's IPO. Oatly, the big maker of milk alternatives, a non-dairy based milk alternative. It has absolutely soared the past 2 days in the stock market after going public on Thursday morning. I think it's an exciting company. I had fun going through their SEC filing, and it's just really exciting when a company is growing 100% year over year, and maybe it'll be faster than that with their huge advertising push and all the notoriety they're getting this week. So I'm going to dive into Oatly. And I'm also going to discuss our latest passport research report, which I spent a lot of time this week writing. And a lot of that is really specifically relevant to CPG companies because we go into refrigerated trucking, sort of how the sonar product, the data from the sonar product can help food companies specifically that move refrigerated products. How they can utilize that data. So I'll talk a little bit about that, but would encourage you to read that report. And then I'll talk about a couple other things in the world of CPG, one of which is the retailers. Some of the big retailers reported earnings this week, Walmart and Target. And Target specifically had blowout earnings, sort of indicating that the consumer is healthy. And that I think that's good news for CPG companies. And then also just touch on one other topic in terms of environmental friendliness, which I think there's really starting to be a packaging revolution, and I'll talk a little bit about that with the use of less plastics. But first, before I talk about all of that, a word from our sponsor. Trust the experts at Echo Global Logistics for all your freight, transportation, and CPG shipping needs. Whether you are a Fortune 100 CPG company or a specialty food manufacturer, Echo has solutions to fit your needs. With their dedicated team, as well as EchoShip, a self-service shipping portal allowing you to quote, book, ship, and track, Echo has you covered. Technology at your fingertips and experts by your side 24 hours a day, 7 days a week. To find out how Echo can simplify your transportation management, please visit www.echo.com/CPG. Visit that today. So big thanks to Echo Global Logistics for sponsoring our the Stockout CPG podcast and show. But I'll get started with Oatly. So Oatly, if you haven't been following this week, pretty exciting. Went public Thursday morning, and we sort of got the indication before it went public that it was gonna have a good week. It priced at the high end of its range. The IPO range was $15 to $17. It priced right at $17, which indicates that the brokerage firms that were taking it public was getting a lot of interest from institutional investors, and it was oversubscribed. So all of a sudden, that's a positive indicator. And then, it went public Thursday morning. It got a 19% pop yesterday, and then is up another 9% today to bring it to $22 a share. So some of those celebrity investors that got in about 10 months ago have made, by my rough calculations, about 6.5 times their money. This takes the valuation to $13 billion. So you look at what comparable sort of companies are, and there's really not a lot that you really would say that's similar to Oatly, and maybe I should spend a minute just talking describing who Oatly is. They are a company that makes products that are alternatives to dairy-based products. So their main product is a milk alternative that uses oats, and they have various other products that are dairy-based alternatives, like ice cream and so forth. And basically what you think of as dairy, they're substituting, oats for the cow. So they're big on, not, having, the cow and any, portion of it. And it sort of is similar in some senses to some of the other, companies that I've been talking about here recently. I mean, I've tried to find trends in CPG that I find that are interesting because CPG tends to be a slow growth industry. It tends to sort of grow GDP minus usually, and sort of more based on population growth. But oat milk is one of those areas that is really hot right now. So this takes the valuation up to $13 billion. If you look at sort of a similar company that you might think, well, this is an alternative food type company, would be Beyond Meat, and it's a little more than double Beyond Meat's market cap. So Oatly. Investors have been very, very, receptive to it. I think, maybe one of the differences is that there's less, competition. Oatly is maybe swimming in a blue ocean a little bit more than Beyond Meat is. Beyond Meat, one of the investor concerns has been the competition from Impossible, as well as competition from other established meat companies that are coming out with some of their own alternative hamburgers and other type meats. But Oatly, they've shown in other markets that they can dominate a market, or be at least the largest player. Do you think it could get to be a controversial name? Well, you'll have investors on both sides of it, because it's one of these companies that's growing very quickly, losing money. I think that a lot of that's by design, but I think you'll definitely have lots of people on both sides of this one, just like you've had a lot of people on both sides of Beyond Meat, on both sides of that trade. So I think it's going to be an interesting one to watch. A couple of highlights from the SEC filing is, last year the company's revenue more than doubled. It went from about $200 million to $421 million. And one of the surprising things is, even though it's in this, hyper fast, growth mode, it's not exactly an overnight success. It was founded in 1990, and this is a Swedish company. And for a long time, the only people who sort of knew about it were, or knew about oat milk at all, were lactose intolerant, or vegan, or for some reason avoided dairy. But lately it's really sort of gained a lot of traction. And sort of another financial highlight here is that it went from losing in 2019, when the company had $200 million in revenue. It lost $35 million net loss in 2019, and that expanded to a $60 million net loss in 2020, with that $421 million in revenue. So the losses are getting wider, and I think that's by design. The news articles that sort of touted that as being a risk. Of course, it's a risk, but I think that the idea is to grow the revenue as fast as possible, get people in the habit of changing their habit, and getting them used to oat milk. And right now, you're seeing their advertisements pretty much everywhere. You may remember the sort of Super Bowl ad where their CEO was singing "Wow, No Cow" in a field of oats. Not a very good singer. Some people hated the advertisement, but it sure got your attention. And now it seems like you can't go anywhere without seeing some of their advertisements. And they've had a really aggressive advertising campaign. That's what you're looking at there is one of their main advertisements, where it says it's like milk but made for humans. I think there that might be a picture of London there, but there's the same one right next to where I live in Dallas, and sort of gets you thinking, okay, well, maybe milk isn't made for humans, made for baby cows, and we should be drinking something else. And I think it sort of gets people's attention. They have a lot of ads sort of around that. They revamped their advertising campaign in recent years, and have done a lot of just really things that are aggressive in ads. And one of those things was they were sued by the Swedish milk lobby, which they will describe it as being kind of like one of those lobbying efforts that's similar to like the guns in the U.S., or to big tobacco in the U.S. that is really aggressive, and really aggressive lawyers and things. And what they did was that, they got this lawsuit from, the establishment in Sweden and the milk community, and it basically claimed that they were misleading consumers with their advertisements because they had a cow, and they didn't think that, said that, well, the consumers wouldn't understand that this is not milk from a cow. It was pretty ridiculous. And what they did was they took so the forms they got from that lawsuit, and they bought ad space, and they published the lawsuit that was filed against them, and in newspapers and magazines and things. And it really won them a lot of fans because people could look for themselves to see how silly some of these things are. And so they've really sort of plastered the world with some of these ads. But the company's ethos is environmental friendliness. I think a big part of that is there's a lot of energy that goes into milk production. And when you think about oats, they're a low input crop, which uses fewer, resources, in the agricultural stage. It allows for the possibility of crop rotation, and oats have, longer, shelf life than dairy is another, big advantage. And, oats can be farmed all over the world. And so the idea is when, the portion of their SEC filing was talking about their supply chains, they really want to be able to locally source as many materials as possible. So you may get a little bit, seems like you may get a little bit of different product, depending on what region that you're in. But I think that goes for both, the ingredients and as well as, the packaging. So they're clearly going after the clientele that that cares about the environment. I think the investors that are going to be attracted to this are ones that are maybe it could be perfect for an ESG portfolio. There are some portfolios that are specifically invest in companies that are green. But here I've got a couple bullets points here where what's the bull argument for Oatly. And I think the bull argument for Oatly, in a sense, is look how great they've done in their home country of Sweden. In Sweden, oat milk is the biggest milk alternative. It's about 70% of any sort of dairy alternative is milk. It's far bigger market share than almond, soy, et cetera. And within that market, Oatly has a 50% market share. And so they've demonstrated in a small market, their home market, that they're able to command a large portion of the market, and the potential that oat milk grows where Oatly goes, essentially. So as they go into other countries, consumers will start drinking oat milk, using oat milk in their cereals, using oat milk in their coffee, which is they recently struck up a deal with Starbucks, and you can get these at sort of basically I think any Starbucks location now. And Howard Schultz, the former CEO of Starbucks, was one of the big backers in this company. So consumers are going to get more interested, more used to this, more interested in this. And so you would expect oat milk to take share from almond milk, which is bigger in the U.S. than oat milk is currently. And so the market for oat milk will expand, and then Oatly will be the dominant player there too. And there's a lot of runway for growth. And then another point here is it's just the environmental concerns are getting bigger and bigger. We don't know what's coming down the pipe with taxes on carbon. That's I think a risk to maybe the establishment. And the Oatly, because it's such a big part of their ethos, is environmental friendliness. They actually have the carbon footprint labeling on the packaging, similar to you would have a nutritional a labeling on the packaging. So I think that's pretty interesting. And then I also think on the bull side that there's a takeover premium that's going to be with the stock for some time. I think there's a possibility that this company gets acquired by one of the big established food names. And the reason I say that is when you go through the financials of let's say a Nestle or one of these big packaged food companies, they are expanding into the markets in packaged food that are faster growing. So those are would include pet food. They would include anything that's healthy, that's organic. Nestle, for instance, acquired Persona, vitamins. Those are some of the faster growing areas of the market are these, better for you products, better for the environment products. And, the companies have been, the big food companies have been making a push to expand into those markets and to divest, some of the slower growth markets that are growing less than the overall, rate of, consumption, things like, Nestle selling its, confection, business. So I think that's going to keep, shares, potentially keep shares high with the takeover premium. The bear argument is that there's a lot of hype in the valuation, and if you were to just look at how do you value this company, it's tricky. I mean, now that we're at a $13 billion market cap, and I just told you it's about 400 million in sales. That's 30 times revenue. So that's one heck of a multiple, even for a company that's growing very quickly. And you look at just how quickly that valuation has grown. 10 months ago, that latest round of funding, which involved those celebrities that bought in, that was about a $2 billion valuation. So it's gone up, let's call it 6.5 times in 10 months. And how possibly could it be more valuable, that much more valuable in that period of time? The other sort of bear argument was, this is the market here is going to be limited to, for lack of a better term, hipsters, people that are huge on the environment, consumers willing to pay a premium, and that's not necessarily everyone. So I think there's some arguments on both sides, and the other bear case is that the big food companies will come in and compete heavily with them. I just saw a couple of the newsletters I subscribe to that deal with food. They just rolled out, new, food products some of the companies have. So it's going to be a crowded space. What you're looking at this on a screen now is a research report that I worked with my colleague Tony Mulvey on. We wrote 15 pages, which maybe might have been too many, but a report on refrigerated food. So we titled this paper "Cold Comfort." Companies can benefit from using real data, reefer data, so it's refrigerated trucking data, as their costs for freight and everything else rise. And so the reason I called it "Cold Comfort" is that we're making the argument that you can take the data that we have in Sonar, use it to your advantage to hopefully help mitigate some of these rising transportation costs. It may be cold comfort, from the perspective of a food company or a refrigerated shipper, when your transportation costs are rising, your labor costs are rising, your packaging costs are rising, all of these things. So I think it's a little bit of a difficult situation. I go through in that report, talk about the challenges that food companies are facing. I talk about the challenges of shipping refrigerated goods as opposed to dry goods. There's a number of greater challenges there with reefer, things like greater lane imbalance, and just right now just higher rates and higher tender rejection costs. On the right side of that screen, talk about some of the ways that we sort of get there in terms of learning about the reefer market, finding data in reefer that we have in Sonar that can help a packaged food company. Some of them are sort of our traditional metrics, like the electronic tender data, where we're looking at tender rejections, or reefer companies rejecting loads inbound and outbound in every market in the United States. We're also looking at transactional data for completed loads, which is a data source where we can look at the contracted rates, and then a shipper can benchmark those against his own rates and see which lanes he's paying above market, which lanes he's paying below market, specifically in reefer, so can determine which lanes may need some adjustment there. We also have predictive spot rates, which has been something that has sort of confounded the transportation industry for a long time. It's difficult to predict what the spot rate is going to be on any particular day. We do have an algorithm for that uses a lot of the historical trends, where spot rates do tend to be sort of mean reverting. They get overheated, and then they sort of go the other way, which would indicate that right now the spot rates are on the high side. We also have a lot of data in there on carrier performance, and I think that helps food companies in negotiations to see just how the the trucking companies that ship reefer goods are performing, which is difficult to see from just looking at data from the publicly traded carriers, because those do not represent the industry as a whole, and there aren't very many of them. There's really just the one. We also have load board data, lots of data to see, where loads are falling through the routing guide, and what the market clearing price is. Some of the other key findings that we had in the reports is, we estimate that transportation costs are around, let's call it 5% of companies' cost of goods sold. They get included in the cost of goods sold in the income statement, and there's a wide range of companies in packaged food have a wide range of margins. The ones that have the name, household name brands, when you think about, Nestle or Mondelez or some of these others that, have, Pepsi, like, their products, you have the really strong, brand names that everyone knows. A lot of those companies can earn margins that are, gross margins that are 40% to over 50%. Whereas some of the, food companies that are like a Tyson or JBS that do the meats, their margins are more in that 11, 12, 13% range. So you sort of think, okay, who's going to have the biggest impact of taking freight out of their costs? I do think it's a lot of those lower margin companies that that where the cost to move the goods is a larger percentage of their revenue, because they don't have the wide margin. So I think food company or meat companies specifically within food are some of the ones that have the most to gain from using some of our data. And should mention, if anyone does want a copy of that report, happy to send it to you. Just shoot me an email at mbaudendistel@freightwaves.com. So move on from that. Just a couple other things that caught my attention this week in the world of CPG. Actually, this one is a little bit more, Andrew Cox's area in retail. So most of the CPG companies have already reported their earnings. They reported their first quarter in, let's call it, about a month ago. But the retailers do things a little bit differently because of the January returns. They tend to report about a month later. And so this week we saw, Walmart report, Target report, a couple others. The one that really sort of stood out to me was Target, which is good news for CPG companies that sell into Target. Their comparable sales up 23%. That's on top of 11% growth a year ago. So growing very quickly, don't seem to be, slowing as they start to lap more difficult, comps as people rushed out, at this time last year to fill up their pantries. But what's interesting too is their e-commerce growth is still very strong. It was up 50%, and that was on top of 141% e-commerce growth a year ago. And Target's e-commerce approach is a little bit different. They have the stores as at the center of their multimodal strategy. So 95% of the company's e-commerce was fulfilled by store assets that were already in inventory. So I think maybe the thought that everyone that shops online wants their products delivered in a brown box in 1 hour from Amazon is maybe not accurate. And most people every day they drive past 2 or 3 big box retailers, and maybe it's just as easy to pull into a certain lane and pop your trunk, and someone puts the things that you ordered in your trunk, and maybe that's actually more easier for consumers who may not be home all the time or have someone to collect the package. Another highlight from Target, their same store sales are expected to grow mid to high single digits going forward. So that is an expectation that the consumer is going to continue to be strong, continue to spend, even as people get out of their house and go travel. Was at Dallas Love Field yesterday, and it was probably the busiest I've ever seen it. It was hard to find a space in the parking lot. They were almost all filled. So people are back to traveling. It's not coming. It's here. And then I'll give you one maybe negative for some of the CPG companies that may be listening from the Target report is that their private label, which they've had a lot of success with, has been growing in sort of the high 30% range. I think it was up 38%. So you sort of compare that to the comparable sales of 23% for the company overall. They are having a lot of success with their private label brand. So that is something to watch going forward because the national brands did take a lot of share from private label in 2020. We'll see if it goes back the other way the next year or so. The last topic I have for you today, as we have just a couple minutes left, is also related to sustainability, which I think is going to be huge for CPG going forward. And that's in the side of packaging. So Unilever announced this week that they're going to convert its global toothpaste portfolio to using recyclable tubes by 2025. So and sort of rolling this out gradually. But they've been working on a tube for the last 4 years that instead of using a combination of plastics and aluminum that's difficult to recycle, which is why we all throw out our toothpaste tube, they're working on one with high density polyethylene, HPDE. This is going to be easier to recycle, uses a lot less plastic, and they're making this design available for competitors to use. Presumably because they want the environmental impact to, throughout the industry. And so this sort of expands upon this company's, Unilever's existing push to reduce plastic use. Sort of they recognize that plastic usage, in itself is maybe one of the least environmentally friendly, ways to package something. They have a plan to reduce the amount of virgin plastic they use from 2020 to 2025 by half. And the company is using at least 25% of recycled plastic in its packaging. So really, making a pretty big push there. They've also launched a toothbrush that uses 100% recycled plastic and 40% less total plastic than traditional toothbrushes. So you may get to the point where you can barely feel your toothbrush because there's going to be, they're so light, but there's a good reason for that, because it's more environmentally friendly. One that I thought was interesting is they've also teamed up with beer and spirits producer Diageo, which is known for, those liquor brands like Johnny Walker, and essentially using bottles that are essentially paper bottles. They're made with recycled, wood products. So those are an alternative to using, bottles that are, made out of plastic. And then on the intermodal side, Unilever is a huge user of intermodal, which is what they use for most of their domestic surface transportation, which has about 50% of the fuel surcharge is truck. It usually saves shippers 10 to 15% off of their freight bill. And what I've been impressed with in terms of Unilever's use of intermodal is that my understanding is that they use intermodal in a lot of lanes that are not real dense and not traditionally what you would think of with intermodal. With intermodal, you tend to think of these big corridors, LA to Chicago, which is the biggest lane, LA to Dallas, which is the second biggest lane. But they use it in lanes like St. Louis to Jacksonville, where there's not a lot of density there, but they're willing, because a lot of their goods are not time sensitive. They have been using those heavily in very, very secondary lanes, and so it does seem to I think lend a lot of credibility to their environmental efforts when they ship intermodally in some of those lanes that you would think would be truck lanes. So a lot there this week in terms of environmental impact, and that's really about all the time that we have. But if you're interested in these type of topics, please go to www.freightwaves.com/the Stockout. I do a newsletter each week talking about CPG companies and what's happening with their supply chains. And feel free to send me an email at mbaudendistel@freightwaves.com if you want to touch base, if there's topics you think I should cover, if you want to learn more about Sonar or FreightWaves, feel free to reach out anytime. So with that, hope everyone has a great weekend.